Well, hello everyone, we're back again with another in our series of Meet the Managers. Very pleased today to have Paul Mattick from Mercia with me. Paul, do you want to say hello and welcome yourself?
Great, thank you very much, Mark. It's really interesting and I think useful to be on these initiatives of Meet the Manager with the ISA. I don't know, so I don't know how much people need to know about Mercia or want to know, but it's a high level. We are a very reasonably large early stage technology investor, about 0.9 billion under management across different strategies, 400 portfolio companies, 110 people across the UK. So,
very short, very succinct. Thank you very much. That'll do. So look, today we've got various things we're going to cover in talking to Mercia. I know Mercia do a lot of different things in a lot of different areas, so this should be a good one in terms of sort of coverage. So, but we're going to start with EIS 5 tax reliefs, one of the most tax advantaged investment schemes in the world. But your philosophy, your thesis is that we should concentrate more on the investment, much more on the tax relief. So do you want to kind of explain that a little bit better than I did?
Sure. So yeah, the EIS itself actually isn't an asset class at all. It's just a tax wrap, it's like a pension. So I think you always want to think about what's underlying the tax reliefs and what the asset is underneath the tax wrapper. Otherwise, well, is this the old saying of the tail wagging the dog and the tax tail? So what we're very focused on as a Mercia, in fact, it's not related to the tax reliefs. It's more about the asset class which we operate in is venture capital. So we are an early stage technology investor, and we've been doing this since 1982. And we have some funds which have tax reliefs, so VCT and EIS, yes. But we also have a lot of funds which are not, have got tax reliefs, including our own PLC balance sheet. So the asset class itself is an attractive approach. It is quite sophisticated, and venture capital itself, and you need a manager who's suitably skilled and experienced in delivering the outcomes you're looking for. But if you get that right manager, and one of them is Mercia, and then you wrap it with a tax wrapper, then there's this double benefit, and it's the venture capital asset class itself can provide very strong returns, and have the wrapper around the outside, it's even better. And there are some unique properties of EIS that support the portfolio level returns. So everyone knows about income tax relief, and a lot of the reason people invest is because of a capital gain. So that's fine, and they both got their very important. But one thing which we talk about quite a bit is loss relief, and because that protects the downside. So effectively, on any single EIS investment, you can only lose 38.5% of the original capital, because you have the income tax relief and loss relief, and together you can basically support the majority of the downside. And that's important in isolation. And you can imagine if you're investing in one company, yeah, that's great. You've got this downside protection. But from our perspective, we create diversified portfolios of companies into our fund, and we do expect failures. So the stage we invest at, but the loss relief enables company by company, you get downside protection, and the upside is not limited by capital gains tax. And I think the combination of those really does support venture capital approach really well. So I think EIS is a scheme is perfectly fitted for what we're doing.
You mentioned venture capital there a couple of times. Just want to give us your definition of what venture capital is.
Well, I know it might not be accurate, but I tend to use venture capital interchangeably with early stage investing, and because that's what we do. We are very much an early stage investor. We're investing from seed through to kind of Series A, Series B. So first institutional money in some cases, first money in, and that effectively is what venture capital is early investing in technology companies which have the potential to deliver these venture returns, so 10 times cost or more, and some companies that might return the entire cost of the fund. So so venture capital isn't a particularly well used term within the UK. Obviously in the US it's very common, but I think that does actually describe what we're doing quite well, because we are looking for some breakout winners, and amongst a portfolio of companies which will some of them will fail. And I think the also the high level metrics make sense in terms of venture capital VC, and that you tend to see quite strong IRR returns, so internal rates of return. So we're looking at returns that are kind of 15 to 25% per year, and that's excluding tax reliefs, and that's kind of what we're delivering.
And I know because you won our award before in terms of best exits, our awards. In terms of exits and building towards an exit, obviously, as you say, venture capital is all about early stage investing. But how do you get to that point where you're looking to exit and make it a successful exit?
Good question, and it's very complicated answers which we can go through. But I think a lot of it is about institutional experience, and we've done an awful lot of exits, and probably close to 100 now, and including say 4 in the last 8 months for our EIS fund, and including the one that won the Exit of the Year award, and that's actually quite a good way to look backwards at the process. So we're always thinking what a good exit looks like for each individual company when we enter it. It can take a long time to deliver build value in companies. So we say 5 to 7 years, and to be clear, it can be a lot shorter, but it can be longer as well. So one of our exits we've had recently was 2.5 years for an ATEX, fantastic IRR of 122%. 2.5 years means there's a few problems with the tax reliefs, as you imagine, the clawback. However, 8 times in a short period, yeah, I think that's acceptable. But on the longer time frames, we have seen some companies. So the one recent exit we did last week was 7 years and 3 months, which sounds like a decent length, but that's kind of within our expectation, and that returned a good outcome. And then we have had even bigger returns which have taken longer. So as the group, I think one of our best exit was in Blue Prism with 104 times exit, which was a massive return, but I think that took about 13 years. So on an IRR basis, that wasn't fantastic, but it was obviously, and you put 10k in and get over $1 million back, I think most people will be happy. But yeah, so but that's the outcome. How we get there is basically we are very active on the board right from the start. We take a board position, we build our position in companies which are growing well. We're always looking at the right time to exit, and sometimes it's to do with the management team when they want to realize value, and sometimes it's more to do with the market, and where we think the market's going. But actually creating exits is not an easy process either. So obviously we use corporate finance, etc. We can AIM list, but or list on markets and deliver an exit that way. But it just seems sometimes it runs hot and runs cold. At the moment, there's an awful lot of M&A that we're seeing coming inbound, which is in some ways surprising in COVID, but other ways makes sense. But yeah, with a lot of exits, and that's probably why and how we know how to do them. Yeah.
And then just trying to make it a balanced conversation. Obviously, you talked about the exit, which is great, and obviously you talked about 10,000 turning to $1 million. Obviously, yeah, fantastic returns. Flip side of all that is that there are some failures in what we do as well. So how do you communicate that to clients? You talked about obviously share loss relief and using the tax relief there, which is a great useful benefit. But in terms of kind of managing the process with one, the company, and two, the client, do you want to give us a few thoughts on that?
Sure. So we try to make an orderly and timely company winding up. It sometimes does take longer depending on the type of low value exit. We always look to get some value back from any exit process, and whether that's selling back to management team for small amounts, or whether that's an asset sale or whatever on the companies that don't do so well. We always try to recoup as much as possible. And when the companies are finally wound up, then we issue a loss relief letter. Investors always, well, they can do the initial value claim route, but when we can formally say how much their shares are valued at, we give them that notification, and that tends to be the driver for making that loss claim. We do expect kind of a third of our companies to fail, so that's our model. So investing early means big multiple exits, but it also means companies are at higher risk. So it's that balance, and that's something we're very clear about in our marketing literature and sales process. But and we actually aren't achieving our expected failure rate, which is great in some ways, but we shouldn't under explain that the companies will fail within a portfolio, all portfolios.
Yeah, I think it's important to over-promise and under-deliver. Other round, sorry. Under-promise and over-deliver, isn't it, in a sense?
Indeed.
You mentioned kind of COVID there, and obviously you can't do any interview without mentioning COVID at the moment. And more importantly, more about M&A activity and how it's busy at the moment. How are you seeing kind of the post-COVID world, and what type of companies are you kind of seeing and investing in at the moment?
Yeah, so I think a year ago, almost exactly a year ago, when we were locked down and started this COVID era, no one really knew what was going to happen, and it's all new to everyone, and I think there's a lot of conservatism out there. But what we've seen happen is in specific sectors, some sectors have closed down, to be clear, close to close down. Tourism was an obvious one, and pubs and restaurants and all travel almost. But there's other sectors which have had the exact opposite impact. So e-commerce and healthcare and all sorts of, gaming, in fact, as well. So there's some sectors have been massively positively impacted, and through luck, stroke fortune, stroke good planning, Mercia is an investor in most of those sectors which have done really well. We're a big healthcare investor. We do quite a lot in software, especially B2B software and e-commerce. So we've had quite a few kind of positive impacts in terms of actual baseline revenue. In terms of M&A, so we've never seen such a busy 12 months as the last 12 months. And that might be a surprise to some, because you think, okay, so COVID, everyone's locked down and they're not doing anything. But actually, people are doing things. They're just doing them from home, and they've actually got probably more disposable capital at the moment, and people are looking forward to the new directions of how the world's going to operate, really. And that has caused a lot of big companies to reassess their business model. And I think they've been looking and saying, okay, there's a gap in this space, whether it's like we've got a groceries delivery company, which we've invested in a while ago, and that's a massively hot space at the moment. And all of a sudden, the entire world's looking at that space. And like, it was partly fortune, but also good planning, I'm sure, that we're in that. And there's all these companies which are looking to pivot into that space. And so you think about, obviously Amazon has a massive delivery force, but there's kind of more supermarkets around the country which are trying to work out how to operate in the new world order. And it's difficult. And the quickest way to make a big pivot in some areas is just to buy a company. And so we're seeing various corporates who are just looking at small companies and saying, okay, this will enable us to move into the post-COVID world effectively. And we've seen it across the board. There's been company approaches, especially in healthcare, but also in software. We've got an HR software company we sold in October. Had a vaccine company we sold last July, which again is not surprising. Just sold a lab automation company a week ago. Again, not particularly surprising. And there was a sales software which we sold in December, all EIS, which it kind of fits into what we're seeing. And that's carrying on. We've got various offers for portfolio companies at the moment, partly as a result of COVID, and the prices are probably higher than we expect, because I think the big corporates have got this mandate to prepare themselves for the new world order. Yep. And that means spending some money. So yep. That's fine.
And that new world order you talk about, obviously, it might change the way that you invest, the way you look at things, particularly companies. Obviously, there's been a move recently in terms of trying to find mission-led companies rather than particularly profit-driven led companies. So I'm thinking about ESG, and obviously there's been a few ESG funds come out recently or have ESG credentials behind them. How do you think about this area? Is it a fad? Is it something that's coming? Is it a sustainable process?
Well, ESG is core to everything. Like, I wouldn't even call it an asset class again. It's more something which underpins everything. And I don't. It's strange kind of thinking as a fund, ESG funds, and all that, because it's not. Yeah, there's some metrics where you need to achieve to be qualified as an ESG fund, but especially we've always been very heavy on the governance piece. So that's basically how we drive value. So by looking at the management team, making sure it's got good corporate governance in place, building out the board, bringing in people who have more knowledge than they do in that space. It's slightly commercial, but it also is about good governance, because companies with good ESG grow better and have better acquisition targets. And the E&S part is something which, it's something which in some cases is very relevant to our companies, and they are in social spaces, and various other companies, it's a bit more marginal. And so we've got a company which it helps stop oil pipes cracking and detects corrosion. And you think, okay, but it's working with oil and gas, so it can't be ESG then. But then it's saying, but it's stopping natural disasters. So there's kind of this boundary as well, and it's easy to have these metrics and say anything in oil and gas is not ESG. But I think we're not a vice investor. We're not investing into guns and tobacco and things. We never have been. And ESG is basically we're kind of codifying what we're already doing. And we've always had a look for social, and we've always been supportive of local schools and lots of donations from internal, lots of fund runs and things to raise money for charities. And I think something what Mercia is doing, but also we're trying to have it as an element of every board that we sit on. What is your ESG policy? How are you giving back to your community? So we've got 400 portfolio companies. So if Mercia focus on it, then actually it should flow down into a broader range of companies.
So is it the point then a good, well-run, well-managed, well-governed company is doing all these things anyway, and doesn't need to kind of tick boxes or look for charters to sign up? Is that the point?
Yeah, and again, I think there's a potential that just because it's got ESG in the name of a fund, that you end up paying much more for it, and there's no different. It's just that terminology is useful from a sales and marketing perspective, and you've got to look under the bonnet and see actually what the difference is. And and to be clear, a lot of most startup companies will be pretty clear on an ESG perspective, because we've got very short supply chains, and there's nothing going to go into China or into the sweatshops and things. There's nothing. You struggle to find in our portfolio anything which wouldn't be ESG compliant. We've had an advisor who was saying your portfolio, although it isn't designed for ESG, is actually better than actual ESG funds, because you haven't got these long supply chains, which things like Apple and all those, Amazon, and obviously, and all the companies, and obviously all the high street stores which are making clothes and things which will be in sweatshops in Asia. Obviously, they're not ESG compliant, but it's quite hard to find funds which haven't got high growth companies such as those in them.
Yeah, and I guess that's the point of EIS, isn't we're trying to grow UK companies, we're trying to keep those companies in the UK, and we're trying to help support those entrepreneurs in the UK as well, which I guess leads on to kind of my last question, kind of around regional investment. I know you guys are based in the Midlands, do a lot of investment in the regions and outside of that, and we did a study a few months ago, 2 or 3 months ago, looking at where investment was across the UK, and about 70% of it was in London and the southeast, and there's obviously a need and demand to try and drive some of that investment out towards the outer regions of the UK. So again, do you want to give us some thoughts on kind of the Mercia approach to this?
Yeah, so there is a big disparity, as you say. 70% goes into London southeast, which doesn't reflect the location of the high growth companies, quite simply. And what this creates is a situation where the London companies end up being highly priced. So there's lots of money chasing a few companies. The price that the company raises capital at spirals upwards. And to be clear, that's the main reason that we don't invest much money in London. the southeast. And if it's well priced, we will invest in the London and the southeast. But what we see progressively more so is that it's inappropriately priced. So that's the fundamental reason why we are a regional investor. We have mandates from the government to deploy capital in the region, so the Northern Powerhouse, the Midlands Engine, Northeast Venture Fund. And actually that's for the same reason. So the reason the government wants money deployed there is because there's enough money in the southeast, and there's not enough in the regions, as you just mentioned. So it just means that we're enabling entrepreneurs outside of the southeast to fulfill their potential with our support. We're deploying £100 million a year, and that's going to increase into regional companies. Some of it will go into London, but that's, as I say, that's more of a pricing dynamic rather than we're not actively looking for London-based companies. We don't want to participate in the Me Too exercises that go on and create these massive bubbles, which it just, from an investor return point of view, it doesn't work. And so if you're investing into a company which is half the valuation in the Midlands compared to London, which is probably fair enough, that's probably what you would expect. So if there's a company in London which is, say, got $1 million revenue, recurring revenue, you can easily pay, I don't know, 15-20 million for it, and to buy shares in it. But in the Midlands, where there's actually very little money compared to the amount of startups, you probably get into it 5 or 10 million, which is still, buying shares at half the price means on the exit, which should be the same, with the same valuation at the exit point, then you get twice the return. And quite simply, from an entrepreneur in the Midlands, that makes a lot of sense for them to be able to feel their potential. For investors, it's a much better return and actually makes the EIS market sustainable and not something which is just you're participating in a bubble. It can, once you actually return cash regularly to investors and they can see it's working, and they reinvest proceeds, and it becomes a positively reinforcing market. And that's where I think EIS needs to get to. So we're seeing almost more cash returns than you see investment coming in each year. I think that's the dream for EIS, I would suggest. And I know this year we're certainly going to return more cash to investors than we've taken in fundraising. So, which is a great stat. I'm very proud of that.
Yeah, that's a fantastic stat. So yeah, hopefully we'll see a lot more of that not coming through, not just through from yourselves, but from other EIS providers as well. It's long overdue in that sense. I think it goes back to my point earlier as well, just talking about the regional aspect. A good company is a good company, again, regardless of whether it's in London or Southeast Exeter or Northeast Scotland. A good company just is a good company, and I guess that's predominantly what you're looking for.
Definitely, and always looking at the market fit as well. As you say, we've got the same process we had before COVID, but COVID has changed how we look at companies in terms of the lens of the market, and to a certain extent also changed how we do due diligence as well, because we've got to do it all more remotely, which has been a bit of a challenge in some ways, but we're a remote workforce anyway, so say we've got 8 offices across the country, so it's not a big change on that side. But actually looking into the eyes of the management team and over Zoom is quite different than actually being in the room with them. And ultimately, you have to trust the management team. Yeah,
well, hopefully, touch wood, we're moving back towards being able to look those entrepreneurs in the eye again, having real physical meetings at some point in the very near future. So let's fingers crossed for that one. So, Paul, thank you very much. I'll wind up there. I think it's a very interesting 20-25 minutes, just giving a bit of a helicopter tour on all things early stage, all things venture capital, and just what generally you guys are doing at Mercia. So thank you very much for that. If people want to get in contact with you, what's the best way of doing that?
Probably through our inquiries email address, so inquiries@mercia.co.uk, or you can just contact me on LinkedIn or the phone 07496128504.
Perfect. That'll do it nicely. All right, Paul Mattick from Mercia.
Great.
Thank you very much.
Take care. Thank you, guys.